Hello, I'm Nicola and I'm the Managing Director at the Mortgage Hut. If you own a home and you're wondering whether you can use the value locked in your property to get a remortgage and pay off debt, this video is for you. Possibly, yes. There are lenders in the UK that provide mortgages for debt management, but your ability to get a lender to approve a debt consolidation mortgage will be dependent on your circumstances as a whole. That includes your credit report, the level of debt you have, the value of your property, how much equity you own in the property, your level of income in relation to the remortgage amount, how predictable your income is. These things, along with many other factors, help a lender decide if you're a trustworthy borrower with the means to repay your remortgage. But don't let that put you off. Even people with a less than perfect credit history may be able to borrow on a mortgage to clear their debts. It's all about getting the right advice and finding a lender with criteria that you meet. Rules vary between banks and lenders, so while one might decline you, another may be able to provide you with an affordable agreement. A debt consolidation loan lets you switch all your existing borrowing onto one loan, so you only need to make one monthly repayment to one lender as opposed to separate repayments with varying interest rates, terms and separate lenders. Depending on your circumstances and your financial situation overall, you might be able to save money with a debt consolidation loan by finding a lender that charges a lower rate of interest, also known as an APR, than you are currently paying. This won't always be possible, so always calculate your repayments, ideally with a mortgage broker or financial expert, to truly understand how much any hypothetical repayments might cost. The application process is similar to that of a standard mortgage, but the biggest difference will be the focus on the level of equity you own in your property. If you've paid off lots of your mortgage, or if your home has increased in value, you'll have a larger amount of equity, and this puts you in a better position when you're searching for potential remortgage lenders. To reduce the interest rate on their debt, their monthly payment amount, the number of companies they owe money to. Repaying money owed to creditors can be expensive, as typically the interest rate charged for unsecured loans, credit cards and car finance agreements are higher than the rate charged for a mortgage. Combining those debts into one can alleviate some of this stress, especially if you manage to find a remortgage lender that charges a cheaper rate than your current creditors, as that could result in lower monthly repayments. That won't always be the case, as your circumstances, i.e. the level of risk you pose as a borrower for not repaying, will affect the rate you're charged. Credit cards, personal loans, payday loans, overdrafts, car finance agreements. You don't have to get a remortgage with your current lender, but it's always worth comparing their rates too. If a different lender has a remortgage product that is cheaper or has better, more flexible terms, you may be able to switch while increasing the amount you borrow to settle other debts. Typically, interest rates for mortgages are much lower than those of credit card providers or personal loan providers, but that doesn't always mean you'll get a cheaper deal overall. Shifting your debts with a remortgage might make managing your money easier, and sometimes it can be cheaper, but so many factors can affect the overall cost. Lots of mortgage agreements have exit fees, for example, and the cost of this could outweigh any savings made from lumping all your debts together with a remortgage. If your credit rating is low or you have severe adverse credit that's recent, getting a mortgage with a lower interest rate to consolidate those debts can be more difficult, as most lenders will view you as a high-risk borrower. It's important to calculate your new repayments with a hypothetical lender versus your current repayments with your creditors to compare whether a remortgage could be cheaper or not. While having one repayment can be appealing, it might be more difficult to qualify for mortgages with lower interest rates, and in some circumstances, your new loan repayment could end up being more expensive. The amount of equity you own in your property will affect your ability to get a remortgage with bad credit, and usually the more equity you have, the higher the maximum loan, and the lower the interest rate. That's not always a given though, because every lender has their remortgage products and terms and conditions. The important thing to remember is that there are lenders in the UK that are happy to lend to borrowers with bad credit. Some advertise on comparison sites, while others can only be contacted via an intermediary, aka a mortgage broker. Work out how much you need to borrow by adding up all your debts, including your current mortgage, credit cards, car finance agreements and personal loans. Look at your income in relation to your current outgoings. Think about how long you want to repay your mortgage. Compare a range of lenders with a trusted mortgage broker. A remortgage is a big decision, and despite the obvious draw of being able to consolidate your debts, there are some crucial questions to consider. The first being whether you can afford a remortgage. While interest rates for remortgages are typically lower and therefore cheaper than credit cards, personal loans and other unsecured debts, transferring your debts into one loan via a remortgage isn't necessarily the right choice for everyone. If your debts feel like they're spiralling out of control, it's advisable to speak to a financial expert or a debt relief charity like the Money Charity or Step Change. Call us at the Mortgage Hut on 02380 980 304 to find out more about debt consolidation mortgages and to compare the alternative options with a reviewed and trusted broker.